Usually when you think about a corporate earnings call, there's this expectation of just, well, profound boredom.
Oh, absolutely.
Right. You imagine this group of executives reading off decimal points, deploying endless financial jargon, and basically just trying to get through the hour without making any sudden movements that might, spook the market.
Just reading off a spreadsheet in a monotone voice.
Exactly. But if you actually take the time to read the transcript of Gilead Sciences Q2 2026 earnings call, that stereotype just completely falls apart.
It really does. It's a fascinating document.
What we are looking at today for you, our retail investors tuning in to talk tickers, is a transcript that reveals a massive strategic pivot. And it's playing out in real time.
Yeah, it reads less like an accounting update and more like, a literal blueprint for the future of human biology.
Right, because we are watching a pharmaceutical... a company historically known as this absolute virology powerhouse, managing a multi-billion-dollar legacy cash cow.
While simultaneously betting billions upon billions of dollars on the absolute bleeding edge of future sciences.
Things like cell therapy and antibody-drug conjugates.
Yeah, they are attempting this massive corporate evolution, and they're doing it while navigating shifting healthcare policies, intense market competition, and honestly, the fundamental behavioral psychology of their patients.
So our mission for you today on this deep dive is to completely decode this earnings call. We're taking the official transcript, the Q&A session with Wall Street analysts, the raw financial data.
All the dense, unreadable stuff.
Exactly. And we're going to strip away the Wall Street speak. We want to give you the actionable intel. We're going to unpack exactly how this company is driving record growth, the wild pipeline of treatments they are developing, and what this reveals about the future of modern medicine.
And more importantly, what it means for anyone holding or considering the stock.
Right. But before we look at the biology, we have to look at the bank account.
We always have to start with the numbers.
Because there is a massive, and I mean massive, optical illusion hiding in their profit and loss statement this quarter. So let's look at the headline numbers.
If you just glance at the raw, unfiltered GAAP data on the wire, you might actually think the company is in severe financial distress.
Right, because I was reading the transcript and the executives are clearly taking a victory lap, right? They're thrilled.
Oh yeah, they're very happy.
Total product sales hit $7.6 billion for the quarter. That's up 8% year over year. The base business sales were up 10%, which, they explicitly noted is their strongest second quarter growth in 3 entire years.
Everything sounds phenomenal on the top line.
It sounds great. But then you scroll down to the bottom line, and the GAAP operating margin, the generally accepted accounting principles margin, was a negative 94%.
Yeah, negative 94.
And their earnings per share was a negative $6.75 for the quarter. So explain this to me. How does a company grow its sales to $7.6 billion in 3 months and then lose almost all of it on paper?
Well, the mechanics of pharmaceutical accounting warp reality in some very specific ways.
Okay, how so?
The reason for that massive optical loss is literally a single line item. It's $11.2 billion in acquired in-process research and development expenses.
So IP R&D.
Exactly. During the first half of 2026, Gilead closed acquisitions of 3 distinct entities: Arcelix, Tubulus, and Oro Medicines.
Okay, so they went on a shopping spree.
A huge one. And under standard accounting rules, when a pharmaceutical company buys another company specifically for its in-development drugs, so drugs that haven't received FDA approval yet.
Right, they're still in the lab or in trials.
Right, they have to take a massive portion of that purchase price as an immediate expense in the exact quarter it closes.
Wait, really? So they can't just capitalize it and spread it out over 20 years?
Yeah.
Like you would if you bought a manufacturing plant or a new corporate headquarters?
No, they can't, because the accountants treat an experimental drug as a risk, not a guaranteed asset.
I see.
A factory has tangible utility. A phase 2 oncology drug might completely fail tomorrow in a clinical trial.
It could just be worthless overnight.
Exactly. So to prevent companies from inflating their balance sheets with unproven science, the rules require them to swallow the financial hit all at once up front.
Which creates this terrifying optical loss.
Right. But if we exclude those $11.2 billion in acquisition costs to just look at the operational health of the core business, the story flips completely.
And the CFO, Andrew Dickinson, he spent a significant amount of time clarifying this on the call, didn't he?
He really did. He had to reassure everyone. He noted that excluding that M&A impact, their second quarter operating margin wasn't negative 94%.
What was it?
It was a highly profitable 49%.
Wow. Okay, that's a massive difference.
Yeah, that puts them firmly in the top quartile of their peer group. Furthermore, their non-GAAP or adjusted earnings per share was $2.27.
Okay, so their illustrative EPS actually grew by 13% compared to the same period last year.
Exactly. The core business is humming.
Wait, hold on. Let's just ground this for a second for the listeners.
Sure.
If I buy a massive new house in cash, my bank account looks completely drained today.
Right. You look broke on paper.
Exactly. It looks like I'm broke, even if my actual salary at work just went up 10%. That seems to be exactly what Gilead is doing here.
That's a pretty good analogy.
The $7.6 billion in sales is the salary going up. But they took all that cash and bought 3 new mansions.
Right. They bought future assets.
But here's where that analogy breaks down for me, just looking at it from an investor's perspective. If I buy a house, I can walk inside it. I know it's going to keep the rain off my head.
Yeah, it's a physical asset.
How do investors know that an unproven experimental drug platform from a company like Tubulus is actually worth billions of dollars? I mean, that seems like an unfathomable amount of money to spend on things that might just fail in clinical trials.
Well, that tension you're describing, that is the defining characteristic of the modern pharmaceutical industry.
Just betting on blueprints.
Literally, yes. You are buying future revenue streams while they are still just blueprints. You are betting that the molecular science will eventually translate into commercial reality.
Which is a huge gamble.
It is.
Yeah.
And Wall Street investors get very nervous when management teams constantly write billion-dollar checks without proving they can actually commercialize the assets they already bought.
They want to see execution.
Exactly. They want execution, not just endless acquisition.
Which actually explains the very specific signaling they used during the call. Because the CFO explicitly stated, and I'm quoting here, "We do not currently anticipate pursuing additional sizable M&A transactions this year."
Yeah, that was a very deliberate sentence. That is a clear message to the market that the shopping spree is officially over.
Put the credit card away.
Right. The new term priorities are now totally centered on integrating these new programs into their existing infrastructure. It is a necessary pivot from acquisition to execution.
But, to afford an $11 billion outlay in the first place, a company needs a foundational business engine that just prints money predictably, quarter after quarter.
You need a serious cash cow.
And for Gilead, that foundational engine is their virology business, specifically HIV.
Oh, absolutely. It's the core of the company.
And this is where the biology really meets the business in a profound way. The HIV juggernaut is undergoing a massive evolution right now.
It really is. The dynamics are shifting.
So the headline number is that HIV sales reached $5.7 billion for the quarter. That's up 12% year over year. But underneath that $5.7 billion, there is a fundamental shift happening between treatment and prevention.
Yeah, we really need to look at the dual tracks of HIV medicine here.
Okay, let's break that down.
On one side, you have the treatment of people who already have the virus. This is a very mature, established market.
Right.
Gilead's flagship drug here is Bictarvy. It's a daily pill for treatment, and it brought in $3.8 billion this quarter alone.
Wow. $3.8 billion in a single quarter for one drug.
Yeah.
That is just a staggering figure.
It really functions as the absolute anchor of the entire company. It's the regimen of choice for both new patients and patients switching from older drugs.
And still growing, right?
Yeah, growing at a steady 7%. And a 7% growth rate on a multi-billion-dollar base is incredibly strong.
Just a mountain of cash.
But the really explosive growth, the growth that alters the company's long-term trajectory, is happening on the other side of the track.
Which is prevention.
Yes, exactly.
Pre-exposure prophylaxis.
Yeah.
Taking medicine before you encounter the virus to prevent infection entirely.
Right.
And looking at the transcript, it reveals their pre-P business doubled year over year. It actually crossed $1 billion in a single quarter for the first time.
Which is a huge milestone.
Meaning they're now operating at a $4 billion annual run rate just for preventing HIV.
And the primary driver of this is a drug called Yes2Go.
Right, which is a long-acting injectable. You get a shot and you are protected.
Exactly. And the crucial metric they revealed regarding Yes2Go is the persistency rate.
Okay, what does that mean in this context?
After a full year on the market, they announced that more than 70% of Yes2Go users actually return for their second injection at the 6-month mark.
Oh, wow. Meaning they are getting a full year of continuous protection from just 2 shots.
Right. And from both a public health perspective and a commercial perspective, 70% is a highly significant persistency rate for a preventative treatment.
Why is it so hard to get high persistency normally?
Well, when a system relies on individuals taking a pill every single day to prevent a disease they don't currently have, human nature inevitably kicks in.
People just forget.
People forget, they travel, their daily routine gets disrupted, or they lose their insurance temporarily.
Right, life just gets in the way.
Exactly.
Yeah.
So a shot every 6 months fundamentally changes the behavioral compliance equation.
And Gilead seems to be leaving absolutely nothing to chance with that 70% number. Because during the Q&A, an analyst actually asked them how they plan to get that persistency rate even higher.
Right, they aren't just resting on that 70%.
Not at all. The chief commercial officer detailed this massive commercial strategy they deployed called the Ready to Go program.
Oh yeah, this is fascinating from a business standpoint.
They designed it with direct input from pre-P consumers. So it incorporates SMS reminders, educational resources, friendly nudges. But the really fascinating part to me is the inbound and outbound nurse call center.
Yeah, that is a huge investment.
They literally have nurses actively calling people to ensure they get their second shot.
Yeah.
I mean, it just shows how incredibly valuable each one of these patients is to that $4 billion run rate.
The lifetime value of a patient on a preventative regimen is just immense, provided they stay on it, of course.
Right. But there is a very interesting tension in the data regarding their other preventative drug.
You're talking about Descovy.
Yeah, because Yes2Go had this massive quarter, but Gilead's daily pill for pre-PP, Descovy, is still growing significantly.
It is, yeah.
I honestly scratched my head at that part of the transcript. Descovy sales were $801 million for the quarter, which is up 60% year over year.
That's a massive jump for a daily pill.
Right. If Yes2Go is this revolutionary twice-a-year shot that frees you from daily pills, why is the daily pill still growing by 60%? Logically, shouldn't the shot be completely cannibalizing the pill? Why are so many people still choosing the daily routine?
Well, the dynamic at play here is just pure market expansion.
Okay, unpack that.
The overall U.S. PrEP market grew by 14% year over year, which is double-digit growth on an already massive base of users.
So the pie itself is just getting much bigger.
Exactly. Yes2Go isn't just taking Descovy's existing users, it is bringing entirely new populations into the prevention market.
People who wouldn't have taken a pill otherwise.
Right. There is a real psychological barrier to taking a pill every day when you aren't actually sick. It requires daily discipline, and frankly, it serves as a constant reminder of risk.
So the injection appeals to a demographic that just ignored pre-EP entirely because of that friction.
Precisely. Meanwhile, you still have 80 to 85% of total users on daily oral medications.
Really? That high?
Yeah, because many people are perfectly comfortable with their daily routine, they tolerate the pill well, and, they simply don't like needles.
That makes sense. There is also a pricing dynamic the executives mentioned, though. They noted that part of Descovy's 60% growth was driven by, and they called it channel mix, pricing favorability.
Right, the channel mix. That's a classic Wall Street term.
Can you translate that for us?
Sure. Channel mix refers to the proportion of patients paying through commercial insurance versus Medicare versus Medicaid or public health programs.
Okay, so who is writing the check?
Exactly. And shifts in that mix, specifically when it shifts towards commercial insurance, can actually increase the average realized price the company takes home per bottle.
Ah, so even if the total number of physical prescriptions only grows moderately, they make more money per bottle.
Exactly right.
Now, it wasn't all unbridled growth in HIV, though. They explicitly mentioned a slowdown in the HIV treatment market growth in the second quarter, and they pinned it squarely on the Affordable Care Act.
Yeah, this perfectly illustrates how macroeconomic policy directly impacts human biology and corporate revenues.
Oh, so?
Well, during the pandemic and immediately after, there were these enhanced tax subsidies for ACA health exchange plans.
Right, to keep people covered.
But when those subsidies were modified or eliminated, a wave of people basically fell off their insurance plans.
The executives actually explained this on the call. They said these patients became uninsured or underinsured, and suddenly they had to navigate this incredibly complex system just to figure out where to get their coverage next.
And when a patient loses their insurance, their prescription might lapse for a month or two.
Right, they can't afford it out of pocket.
And if you multiply that by thousands and thousands of people, it creates a noticeable, quantifiable drag on total market growth.
Just from the friction of paperwork.
Exactly. Now, Gilead expects this to be a temporary blip. They forecast the market will bounce back to a typical 2 to 3% annual growth rate.
But it really highlights the fragility of healthcare access in this country, doesn't it?
Oh, totally. I mean, the most scientifically advanced drug in the world is completely useless if the patient is locked out of their insurance portal.
Exactly. And because these ACA insurance gaps and just general behavioral forgetfulness are causing patients to drop off their daily pills, it seems like Gilead realized they needed to engineer treatments that bypass daily compliance entirely.
Right. They have to innovate around human behavior.
When I looked at their HIV pipeline, I realized they aren't just looking for a cure. They are trying to own every conceivable unit of time in a patient's life.
That's a great way to put it.
They are actively developing daily, weekly, twice yearly, and once yearly options.
It is an absolute masterclass in patient optionality.
Let's look at the biological strategy behind each of these timelines, because it really reveals the depth of their virology expertise.
Yeah, let's start with the daily options.
Okay. They have a drug combination called Biclin, which is Bictegravir and Lenacapavir. They're actually expecting an FDA decision on this combination this month.
Right.
And they describe it as their first dedicated switch regimen for virally suppressed people.
So the core biological strategy of Biclin is combining two drugs with what scientists call orthogonal mechanisms of action.
Orthogonal mechanisms. Okay, Wall Street jargon alert. What does that actually mean for the patient?
Well, the HIV virus replicates by inserting its genetic material into the DNA of the host's immune cells.
Right.
An integrase inhibitor, like Bictegravir, blocks the specific enzyme, which is called integrase, that the virus uses to splice its DNA into the host.
So it stops it from breaking in.
It attacks the integration phase, yes.
Yeah.
That is mechanism one.
Okay, and the second mechanism?
The second mechanism is the capsid inhibitor, Lenacapavir. The HIV virus protects its genetic material inside this protein shell, which is called a capsid.
Like a little armor plating.
Exactly. Lenacapavir attacks this shell, interfering with its assembly and disassembly.
Okay, I think I follow.
So by combining an integrase inhibitor and a capsid inhibitor, you are attacking two completely unrelated stages of the viral life cycle simultaneously.
Give me an analogy here.
It's like you are bombing the supply lines and simultaneously assassinating the generals in their headquarters.
Oh, wow. Okay.
This creates an incredibly high barrier to viral resistance because it is just exceedingly difficult for the virus to mutate around both distinct attacks at the exact same time.
Which is exactly what a doctor wants for a switch regimen, right?
Yeah.
If someone has been on older drugs for a long time and their virus has maybe learned a few tricks over the years, you want to hit it with this highly potent dual action hammer.
Exactly, to ensure long-term viral suppression.
Okay, so that covers the daily timeline, but then we move to the weekly option.
Right, and the weekly option involves a really complex partnership strategy.
Yeah, they are co-developing a drug called Ilan, which combines Ilatravir and Lenacapavir with their rival Merck.
Which is fascinating on its own.
They shared positive phase 3 data at the International AIDS Society meeting, and they're aiming to launch this as the first once-weekly oral treatment in 2027.
But, and this is key, they're also testing weekly Lenacapavir paired with their own wholly owned integrase inhibitors, the ones they call GS1720 and GS3242.
Wait, so they are effectively racing themselves?
Yes, they are. They partnered with Merck to get to the weekly market first to establish that foothold.
But they are simultaneously developing their own in-house weekly drugs, so they don't have to split the profits with Merck in the long term.
It is a highly aggressive dual-track strategy.
That is wild. Okay, so moving to the twice-yearly timeline. They are initiating phase 3 trials for Lenacapavir paired with two broadly neutralizing antibodies, known as TA and ZAB.
Now, this represents a fundamentally different way of hunting the virus.
How so? How does a broadly neutralizing antibody actually differ from the antivirals we just talked about?
Well, standard antivirals stop the virus from replicating actively. However, HIV is an incredibly insidious virus. It integrates its DNA into long-lived immune cells and just goes dormant.
Like it's hiding.
Exactly. It creates what is known as a viral reservoir, and standard drugs literally cannot see or attack this dormant reservoir.
Because the virus isn't actively doing anything.
Right. But broadly neutralizing antibodies, like TE and ZIB, are designed to recognize highly conserved regions on the surface of the virus. They can potentially mark both the active virus and the infected cells for destruction by the body's own immune system.
Oh, so it flags them for the immune system to do the work.
Yes. It's a strategy aimed directly at the reservoir, and it's delivered just twice a year.
That is incredible. And finally, the yearly option. They have a trial called Purpose 365 that just completed recruitment.
Right, 365 days.
They are evaluating a once-yearly intramuscular injection of Lenacapavir for PPP with a potential launch in 2028. A single shot, 1 day out of 365.
Now, from a business strategy perspective, offering a daily pill, a weekly pill, a twice-yearly shot, and a yearly shot, it raises a really interesting question about market cannibalization.
Yeah, I was thinking about that. If I go to my doctor to discuss HIV prevention, they literally hand me a menu with 4 different timelines. Does decision paralysis set in?
It might.
And from an investor standpoint, is it a risky business move to cannibalize your own highly profitable daily pill with a weekly pill and then cannibalize your weekly pill with a yearly shot?
Well, in classic corporate strategy, this is referred to as moat building.
Moat building. Okay, explain that.
By offering every conceivable timeline, Gilead ensures that no matter what a patient's lifestyle preference is, or no matter what a competitor manages to develop, Gilead already has a tailored solution on the market.
They're covering all the bases.
They are competing with themselves to own the entire behavioral spectrum of the disease.
So if a patient refuses injections, Gilead has the weekly pill.
Right. And if a patient travels constantly and cannot manage pill bottles, Gilead has the yearly shot.
They just lock competitors out by leaving absolutely no gap in the market.
Exactly, because adherence is the single biggest hurdle in treating any chronic condition. By systematically removing the friction of adherence across all these different demographics, they secure that massive revenue stream against outside disruption.
Wow. So Gilead has built an absolute impenetrable fortress around HIV, printing billions in cash.
Fort Knox.
But virology eventually hits a market ceiling, right?
Yeah.
So if you are the management team sitting on that mountain of cash, where do you deploy it to secure the next decade of growth?
You go to war in the most lucrative, fiercely competitive space in modern medicine.
Oncology.
Yes. The oncology and cell therapy pivot is where those $11 billion in acquisitions from the top of the call finally come into focus.
Okay, let's dig into that. Let's look at their established oncology drug, Tredelvi. Sales were up 26% year over year, hitting $457 million for the quarter.
That's a massive jump.
The fundamental driver of this growth, they said, is its movement into the first-line treatment setting for metastatic triple-negative breast cancer, or TNBC.
Right.
For a retail investor who doesn't track oncology clinical trials every day, why does moving from a second-line treatment to a first-line treatment generate a 26% spike in revenue?
Well, triple-negative breast cancer is an incredibly aggressive form of the disease. It lacks the 3 common receptors that standard hormone therapies normally target.
So it's very hard to treat.
Very hard. Now, the line of therapy dictates when a patient receives the drug. First line is the initial treatment right after diagnosis.
The first thing they try.
Right. If that fails to halt the disease, the patient moves to second line. But by the time a patient reaches second-line therapy for TNBC, they are often in a much more advanced state of disease, and their survival window is, tragically, much shorter.
So getting FDA approval for Tredelvi in the first-line setting fundamentally alters the revenue multiplier.
Completely. The executives highlighted that the addressable patient population in the first-line setting is nearly double that of the second-line setting.
Double the patients right off the bat.
Exactly. But more importantly, because patients are receiving the drug earlier in their disease progression, their bodies can often tolerate the treatment better.
So they don't have to stop taking it due to side effects.
Right. And the drug can delay disease progression for a longer duration, so they stay on the therapy longer, which multiplies the revenue per patient.
So it is a biological success that directly translates to commercial growth.
Exactly. It's a win for the patients and a win for the balance sheet.
But Tredelvi is just the vanguard of their oncology strategy, right? Mm-hmm. Because the future, according to the transcript, is heavily focused on ADC's antibody-drug conjugates.
This is where it gets really sci-fi.
And this explains the Tubulus acquisition we mentioned earlier. They highlighted an ADC drug called GS8824, which was formerly known as TOP40, And they said it showed a 61% response rate and an 11-month progression-free survival in heavily pretreated platinum-resistant ovarian cancer.
Now, to fully appreciate a 61% response rate in platinum-resistant ovarian cancer, we have to understand the mechanics of an antibody-drug conjugate.
Okay, let's break it down.
Traditional chemotherapy is systemic. It circulates through the entire body, killing rapidly dividing cancer cells, sure, but it also destroys healthy, rapidly dividing cells.
Like in the hair follicles or the gut.
Exactly. Hair follicles, gut, bone marrow. It is essentially carpet bombing the body.
Which is why the side effects are so brutal.
Right. But an ADC is designed to be a precision-guided smart bomb.
Okay, break down the mechanics of this smart bomb for us. How does it actually bypass the healthy cells?
An ADC consists of 3 distinct components. First, you have the monoclonal antibody. This is the guidance system.
Okay.
It is biologically engineered to seek out and bind only to specific proteins or antigens that are overexpressed on the surface of cancer cells.
So it ignores everything else.
Right. Second, you have the payload. This is an intensely toxic chemotherapy agent. It's often way too toxic to be given systemically on its own.
It would just kill the patient.
Exactly. And third, you have the linker. This is a chemical bond that connects that toxic payload to the antibody.
So if I had this right, the antibody circulates in the bloodstream, it ignores the healthy cells, it finds the tumor cell, locks onto the antigen, and then the linker releases the toxic payload directly into the microenvironment of the tumor.
That is the theory, yes.
Right.
But in practice, the challenge has always been the stability of that linker.
The weak point.
Exactly. If the linker degrades while the ADC is still circulating in the bloodstream, it just drops the highly toxic payload indiscriminately.
Which causes severe systemic toxicity and defeats the entire purpose of the smart bomb.
Precisely. What the Tubulus acquisition gave Gilead wasn't just a single drug. It was a next-generation platform for building these smart bombs.
So they bought the underlying tech.
Right. Tubulus specializes in novel linker chemistries that are highly stable in the bloodstream, but they cleave rapidly once inside the acidic environment of a tumor.
So they bought a better linker technology to ensure the bomb only detonates exactly where it is supposed to.
You got it.
And a 61% response rate in patients who have run out of other platinum-based options. I mean, that indicates that this specific linker payload combination is incredibly potent.
It's very, very promising data.
But then the earnings call pivoted from smart bombs to something even more complex, CAR T-cell therapy.
Chimeric antigen receptor T-cell therapy.
Right. Now, this involves extracting a patient's own immune T-cells, engineering them in a laboratory to express receptors that recognize specific cancer antigens, and then infusing them back into the patient as a living drug.
It's personalized medicine at its most extreme.
But the numbers here were not moving in the right direction. Cell therapy sales were down 14% year over year, dropping to $417 million.
Yeah, that was a sore spot on the call.
Management blamed ongoing in and out of class competition. I mean, it is a brutally crowded space with multiple massive pharmaceutical companies vying for the exact same subset of patients.
Oh, everyone is trying to win in cell therapy.
So here's my question. If cell therapy sales are actively dropping by 14% and you are facing margin-crushing competition, why would Gilead double down by spending billions to buy Arcelix to get full ownership of a new cell therapy drug called Natocell?
It seems counterintuitive, right?
Isn't that deploying capital into a shrinking asset?
Well, looking closely at the details of the Arcelix acquisition, it reveals a long-term platform strategy that goes far beyond just a single drug.
Okay, tell me more.
Natocell, which is targeting multiple myeloma and has an FDA decision expected in December, is really just the media application. What Gilead actually acquired is the underlying engineering technology. It's called the D-domain binder platform.
Okay, explain the D-domain binder platform. How does it differ from the cell therapies that are currently driving their sales down?
Current CAR-T therapies typically rely on viral vectors to deliver the new genetic instructions into the patient's T cells.
So they use a virus to hack the cell.
Right, you use a deactivated virus to insert the code. But this biological process is incredibly complex, highly expensive, and it physically limits the size of the genetic payload you can deliver.
Because the virus can only hold so much info.
Exactly. If you want to engineer a T cell to target 2 or 3 different cancer antigens simultaneously, which you want to do to prevent the cancer from mutating and hiding, a standard viral vector often just doesn't have the carrying capacity.
It's like trying to move a 4-bedroom house in a compact car.
That's a perfect way to picture it. The D-domain binder, on the other hand, is a synthetic modular alternative to these bulky viral vectors.
Okay.
It is a highly compact structural domain that can be easily engineered to bind to various targets. And because it is so small and modular, you can string multiple D-domains together in a single CAR-T construct.
So instead of a bespoke, handcrafted viral delivery system, it's like a synthetic Lego set.
Exactly like Legos. The transcript specifically noted that this modular platform allows them to bypass the payload constraints of viral vectors, which enables them to target multiple antigens simultaneously.
Huge.
They can rapidly swap out the Legos to optimize constructs for different diseases, even extending beyond oncology into the massive market of autoimmune diseases.
So they purchased the Lego factory.
Exactly. They anticipate that multi-targeted CAR-T cells are the only way to win the space in the long term.
The logistical execution of this is equally critical, though, because the transcript highlighted a 98% first-pass manufacturing success rate and an 18-day global median turnaround time for Nitocell.
And we have to pause on that because that 18-day metric is literally a life-or-death competitive advantage.
Explain why.
The patients receiving Nitocell are in the fourth-line setting for relapsed multiple myeloma. Their cancer is aggressive, and their bodies are exhausted from previous treatments.
Right.
They do not have 30 or 40 days to wait for a laboratory to successfully engineer and multiply their cells.
If the manufacturing process fails the first time, or if the turnaround takes a full month, the patient might just succumb to the disease before the living drug ever even arrives at the hospital.
Unfortunately, yes. So a 98% success rate and an 18-day turnaround means a treating oncologist can prescribe the therapy with high confidence that the patient will actually receive it in time.
It removes the gamble for the doctor.
Right. In a fiercely competitive market, doctors will instinctively route their patients to the manufacturer with the most reliable logistics network. Gilead is building the infrastructure to completely dominate the space operationally, even if current quarter revenues dipped.
That structural advantage perfectly bridges into the final segment of their business we need to examine today.
The liver portfolio.
Exactly. We've covered the HIV fortress. We looked at the oncology capital allocation.
Right.
The liver disease portfolio is often the quiet achiever in Gilead's earnings, but this quarter, it delivered some of the most dramatic growth numbers on the sheet.
It really did. The drug Livedelzi is a prime example.
Sales more than doubled year over year, hitting $167 million. It is currently the leading second-line treatment for a disease called PBC, primary biliary cholangitis.
Let's contextualize PDC for a second.
Yeah, why is a second-line treatment suddenly doubling in sales?
Primary biliary cholangitis is a chronic progressive autoimmune disease. The immune system mistakenly attacks the small bile ducts within the liver.
Ouch.
Yeah, and as these ducts are destroyed, bile builds up in the liver, leading to inflammation, scarring, and eventually irreversible liver failure.
And the standard treatments don't work.
Well, the standard first-line generic treatments often fail to adequately control the disease progression in a significant percentage of patients.
So they announced positive results from a phase 3 study called IDEAL, which aims to expand Livedelzi's label to reach these specific patients whose disease is inadequately controlled by the older generics.
Right. They are using clinical data to actively widen the addressable market.
But the more fascinating liver drug mentioned, to me at least, is Tepcludex.
Tepcludex recently received FDA accelerated approval as the first and only treatment for chronic HDV, hepatitis delta virus.
They noted that chronic HDV is the most severe form of viral hepatitis, leading to rapid disease progression and liver failure. But it only affects about 40,000 to 80,000 people in the U.S.
It's a very small group.
That is a microscopic patient population compared to the millions affected by HIV or breast cancer. Why would Gilead focus R&D on such a small group?
It is an orphan indication, yes, but the biological complexity of HDV makes it a massive unmet medical need.
What's so complex about it?
Hepatitis delta is a unique, incomplete virus. It literally requires the surface antigen of the hepatitis B virus to replicate.
Wait, so you can only get HDV if you already have hepatitis B?
Exactly. Because it hijacks another virus's infrastructure, it has been notoriously difficult to target with traditional antivirals. For decades, there were literally no approved treatments for these patients.
Oh, wow.
And they face a much faster route to cirrhosis than patients with hepatitis B or C alone.
So because Tepcludex is the first and only approved mechanism to attack this specific, highly severe dual infection, the pricing power and the value to the patient are just immense, even within a very small population.
Precisely. And this strategy of targeting severe niche diseases ties perfectly into how Gilead manages the overarching life cycle of its liver franchise.
Let's talk about that life cycle, because for years, Gilead was defined by its hepatitis C, or HCV, cures.
Right. They created revolutionary drugs that completely eradicated the HCV virus in patients.
But the pharmaceutical paradox of a functional cure is that it actively destroys its own total addressable market.
It's true. As you cure patients, the pool of potential new prescriptions permanently shrinks.
Right, so the HCV revenues have been predictably declining for years as they successfully cure the population.
But what this quarter's numbers demonstrate is an elegant financial rotation.
Seamlessly replacing the revenue.
Exactly. They are seamlessly replacing that fading, high-volume HCV revenue by launching highly specialized, high-need drugs like Tepcludex and scaling Livedelzi.
They are maintaining the revenue floor of the liver division by pivoting from volume to targeted value.
It's a very smart maneuver.
And that operational rotation, combined with the momentum we saw in HIV and oncology, brings us to the bottom line guidance for the entire company.
The guidance was strong.
Because of this across-the-board performance, Gilead actually raised its financial expectations for the rest of the year. They raised their full-year base business growth expectations to 6 to 7%.
Yep.
They raised their HIV growth expectations to 9 to 10%. And total product sales are now expected to land between $30.1 billion and $30.4 billion.
Now, the most striking metric in the entire transcript, for me at least, is the leverage embedded in their business model.
Okay, lay it on us.
Total product sales grew 8%, right?
Right.
But their illustrative earnings per share grew by 13%.
Now, for the retail investors listening, explain how a company grows its profits faster than its sales.
It is the ultimate marker of operational discipline in a mature business. As revenues scale, a well-managed company should be able to squeeze progressively more profit out of every incremental dollar.
Because the groundwork is already laid.
Exactly. Their corporate infrastructure, their global supply chains, their sales forces, they are already built and paid for.
So when a high-margin drug like Tredelvi grows by 26%, the fixed costs don't increase by 26%.
You nailed it. A massive portion of that new revenue falls straight through the income statement directly to the bottom line.
Looking at the entire holistic picture of this quarter, it really is a fascinating case study in corporate resilience.
It is.
I mean, they absorbed an $11 billion accounting hit for M&A. They faced a quantifiable slowdown in the HIV treatment market due to macro insurance gaps from the ACA.
Right.
They endured fierce, margin-crushing competition in cell therapy that actively drove their sales down. Yet despite these substantial multi-front headwinds, they raised their financial guidance across the board.
Because the sheer gravity of their successful assets is simply outmuscling the headwinds.
The winners are winning big.
Yes, the $4 billion pre-IPO run rate, fueled by the behavioral success of Yes2Go, combined with the strategic expansion of Tredelvi into first-line breast cancer. It provides so much upward thrust that the underperforming segments are mathematically overwhelmed.
It totally validates their diversification strategy.
Exactly. When the cell therapy engine sputters a bit, the virology and oncology engines are firing powerfully enough to accelerate the entire enterprise.
So we started this deep dive with the optical illusion of GAAP accounting, that terrifying negative 94% margin, and unpacked how it was actually the upfront cost of securing future technology through strategic acquisitions.
Right, buying the Lego factory.
We tracked the rise of HIV prevention, exploring how behavioral psychology, consumer tech, and 70% persistency rates are driving a $4 billion market.
We analyzed that moat-building strategy of slicing the HIV treatment timeline into daily, weekly, twice yearly, and yearly options.
Relying on orthogonal mechanisms and broadly neutralizing antibodies to completely outmaneuver the virus.
And we explored the smart bomb future of antibody-drug conjugates.
And the synthetic potential of D-domain binders in cell therapy, plus the life-saving logistics of 18-day manufacturing turnaround times.
Finally, we saw how the rotation of the liver disease portfolio provides the steady leverage that allows them to raise guidance in the face of all those macroeconomic challenges.
It is a remarkable snapshot of a company engineering its way through the complexities of both modern biology and modern capitalism.
It really is.
But before we sign off, there is one final provocative thought that has been lingering in my mind since we discussed the Purpose 365 trial.
the yearly HIV injection.
The once-yearly intramuscular injection for HIV prevention. As medicine evolves from a daily pill that sits on your nightstand, reminding you of your condition every single morning, to a single shot you get once every 365 days. We are fundamentally changing the human relationship with chronic disease.
We really are. We are altering the psychological cadence of illness.
Think about it. If you only have to interact with your medicine and think about a virus one day a year, does the psychological burden of being a patient disappear entirely?
That's a deep question.
We are moving past just curing diseases or preventing them biologically. We might actually be erasing the identity of being sick. If the medicine becomes invisible to your daily life, does the disease finally vanish from the mind?
Wow.
It is something to mull over the next time you take a daily vitamin or fill a prescription. Thank you for joining us on this deep dive into the numbers, the science, and the strategy. Keep questioning the headlines, keep exploring the transcripts, and we will catch you on the next deep dive.